Welcome to Shred the Debt, the podcast that cuts through confusion and empowers you to take control of your financial future. Whether you're buried in student loans, battling credit card balances, or just tired of living paycheck to paycheck, you're in the right place. Each week, we bring you real strategies, inspiring stories, and expert insights to help you shred your debt and build the life you deserve. Are you ready to take action? Well, subscribe now, share this episode with someone who needs it, and join the movement to destroy debt for good. No BS, no judgment, just real talk and real results. Let's get to work. Guys, I'm Mike Boone, and I'm your host, and this is another week of Shred the Debt. Now, I know we've taken off a couple weeks, and I apologize for that. We've had a ton of stuff going on, and I'm ready to get back to work, though. We have been in no shortage of emails from you guys, and I'm just super grateful for the support and the emails that we continue to get. People learning to get a handle on debt that's outside of the normal type of podcasts and content that people are getting. So very grateful for that. I'm glad to be a real life participant and a real life coach for you guys and a real life cheerleader. So thank you for that. And this week's show is actually going to be dedicated to you guys because the last couple of weeks I've had a lot of inquiries and a lot of people reaching out, and the common theme was investing. And I know I've talked about it a little bit when we first started getting into the show and what we were doing and what the purpose of the show was, but we never really talked about investing that much. And for some of you guys, you may be already in that investment boat, and for others, you may not be ready yet. But I think there's a happy medium for everyone. That I don't know. I think that no matter what, investing is a great idea. Right now, I'm not going to say take food off your table to invest, but at the same time, I think it's one of those things that if you can get started at whatever spot in life you are, no matter how small the investment is going to grow. And once you get used to, the little bit of money that's coming out of your check or out of your pay or your savings or whatever, it's going to help you. It's going to help you prepare for your future. And we don't know how long we're here, right? But we anticipate retirement. Everyone has a different view or a different picture of what retirement looks like. I know me. I don't want to work. I don't want to work till I'm 60 or later. You know, there are a lot of people that have no choice but to work up until they're 60, 70, 80 years old. Some people want to. Some people have to. I want to be a person that I want to utilize the skills that I have, but I want to do it on my terms. And if it's for free, then it's for free. But I don't want to have to depend on an income or me working to provide for myself. I want to be able to save enough and to make smart financial choices between now and, say, for the next 10 or 15 years. And I expect to be done with the corporate world or with the, time clock or whatever, working for the man or whatever, however you want to say it. I want to make my money work for me, and I want to be paid from that, and I want to live off of that. So that's my goal. So without a plan, though, you're not going to be very successful in doing that. So that's what I want to talk today and cover that as investing. And it'll be kind of two-part. We'll talk about, self-directed investing a little bit, but the majority of this is going to be investing within the workplace. So I guess we'll just jump right into it. The investing, if there's investing opportunities or retirement, we'll call it retirement opportunities for investing. We're talking Roth IRA and 401k. Those are the two most popular. So I guess with the difference between the two, and I'll tell you guys right now, I'm not a financial expert. I'm not a financial advisor. I'm not any of that. I'm just going to tell you what works for me, what I've done, and my interpretation of what each of these two are. I'm in no way an expert on this, but this is just what I do. And I told you guys from day one, this show's real life, and I'm trying to use my experience to help others. And if if I'm wrong, shoot me an email. Let me straighten me out if I'm just shooting from the hip and sound like I don't know what I'm talking about. So anyway, so the first type of investing within your job would be your 401k. That's pretty typical. The choices that you have with that are pretty limited. I think your company will invest the funds for you, and they will choose the funds for you. I know I've worked in a couple different places over the years, and I guess the risk level is the only thing that I really had control over. Now, whether they invested in certain stocks or certain bonds or ETFs or any of that, and you can use the Googles on this stuff, man. I'm not going to get into all of that today. But the investment packages are based on your risk level. And I've always, even today, I'm at moderate to aggressive risk. Some things are high risk. I've always been the kind of guy that's high risk, high reward. I'm going to be putting into this fund for a long time, so I don't mind that it's aggressive. So I think everything that I have is moderate to aggressive. It's paid off. I think the S&P. I want to think they say that it gains like 7% or something a year or something like that. The Dow, I don't know. There's a percentage of gain every year. I want to think it's somewhere around 7%, and I think my stuff's making 11 or 12% a year, and so I'm pretty satisfied with that. But looking at 401ks, and I know if you listen to Dave Ramsey. He's going to tell you to, you want to try to get 15% of your pay, and that's when you get everything lined up, right? He doesn't even recommend you to start investing until you're able to do that 15%. I guess my outlook on that's a little bit different. Like with my work and other places that I've worked, they have a 401k with a match. And even if you're doing a Roth IRA, there's still a match. So with my employer, I think the match is 100% for the first 3%, and then so that's telling you that you put 3, they give 3, and then I think it's a 50% match for the next 3%. So I think that means that if I give 3, they match 1.5. So the total match is 4.5%. So in order for me to get 4.5%, I'm going to have to invest 6 to get 4.5. So the total is going to be 10.5 if I did the math correctly. So if I'm doing 3, I'm getting 3, and then I'm doing 3 and I'm getting 1.5. So 6% out of my check will yield me 4.5. So I'm getting a total of over 10%. Now the biggest difference between the 401k and the Roth is the 401k is a pre-tax. So that money's going to come out of your pay before taxes. And I mean that's a good deal. The only drawback to that is that when you do take it out, it's going to be taxed as income, probably at a lower rate because you're older, but you will be taxed on that. So anything that money gains over the course of 20 years or however long that you're going to work and contribute to it, you're going to pay taxes on the gains when you take it out. And it's okay, right? So if you're in a position, 15%, if you can't afford 15%, then don't, right? But if you do 3 and you do 3 at the start, 3% is going to be hard to miss. you're not gonna. Well, it's not hard to miss. It's gonna be hard for you to pass up 3%. And I think if you take 3% out at the start, when you start a job and you get your first paycheck and you start budgeting around your income, you're going to be okay. So the 3%, you're getting 3% in free money. You're just giving 3 and you're getting 3. It's like giving 6. So I mean, to me, that's a no-brainer. And if you can work around where you can do 3%, I would totally do it. And you're gonna see that thing pick up year after year when you continue to give 6 or give 3 to get that 6. And then the cool thing is, once you start doing better financially, you can start putting more into your 401k, and then you could start getting that additional up to 15%, and then you're still going to get that match, whatever your employer does match. My employer is spectacular. They provide everyone with a 401k, whether you sign up for a 401k or not. So let's say, like, I have one that they fund, and then I have my own that they match. So they still match, even though I have one funded from them. So it's a great opportunity for my employer, for any employee who is employed with my company, because it's like I say, it's free money. Now, I guess the drawback to the 401k, I spoke about it for a quick second, is that it's taxed when you take it out, and the gains are also everything that it does is going to be taxed when you go to take it out. Now, on the flip side of that, you have what they call a Roth IRA, and my employer also offers that, and that's what I'm invested in. Now, I'm fairly new to the IRA standpoint. 401k is all I ever knew. So the more talked with other coworkers and talked with family, I found that an IRA was probably better suited for me. So a little over a year ago, I decided to change my contribution over to Roth IRA. Now, the difference between those two is the Roth IRA is after tax. So that's going to come out after you've already paid all your taxes on your money. So if it's $50 a week or whatever, it's going to come out of your check post tax. Now, the cool thing about this, and this is really what turned me on to it, and it may have been listening to Dave Ramsey a little bit to understand this and get on board with it, but it was that the Roth IRA is the gains are not taxed. So the money that goes into it is taxed money. You've already paid the tax on it, and the gains that it makes are yours. Now, when you go to take that out, you're taking that money out, and it's no longer taxed because you've already paid taxes on it. So that's kind of cool. I'm not sure if there's I know with a Roth IRA, I know there's a contribution maximum for the year, and I should know that doing this show. That should be something that I should be telling you that, hey, it's this amount of money that you can put in per year, but I don't know what that number is right off the top of my head, so I apologize for that. So Roth IRA, that's the route that I would go. I think that makes the most sense for me. Now, if you want to if you want to give more, if you want to do 15%, if you're in a position. Now, this is where you have to make the determination of what position are you in within your finances that you can do this, and does your employer offer a match? That would be the number one thing. And what is that match? And to start out with, I would only go with what the match was, because that's 100% free money. That's dollar for dollar. So that's what I would look at if I were just getting into investing with my work. Now, if funds are super duper tight, then maybe it's not an idea for you. Um, but I mean, it's when you look at it, it's like I can maybe I can cut something out of my budget or cut something out of my life, cut some sort of habit or something that I'm spending money on. Maybe I can cut that from my life to allow myself for this 3%. That would be more beneficial to you. If you're grabbing a coffee every other day or something like that, and it's if it's 15 or $20 a week, something that you're spending on coffee or something like that, then if you could cut that out, um, you would have the money to go towards your retirement. Because trust me, this you can put the numbers together and the compound interest and the dividends and all the things that the funds do for you that are working for you that you have no idea about. They're lucrative, and if you're new to investing or new to retirement, um, if you just started a job or you're a young person that's new to the job field and you're starting this retirement plan, man, I'm telling you, when you look back at it in 5 years or 10 years, and you're like, man, I have 100 grand in here, right? I have $150,000. Well, when you have $150,000, you still own those shares, and you've been buying those shares for so many years. Just think at what level you're at versus a person that's just starting, right? The price that you have on these shares are a much better price than someone just starting. So the earlier you can start, the better you're going to be long term. And if you're like me, and the first time that I started, I did some dumb stuff with money, and that's what you have to look at too with 401k and your Roth. Please, please, please. Number one rule, the number one rule with investing is never sell at a loss. Okay, that's the number one rule of investing. The number one rule of retirement investing is never cash it out early. Don't do it. Please do not do it. Now I say this with a lot of respect to people that have had to do it. But man, make that your last resort. If you ever have to take from your retirement, please make sure that it is your last and only resort to keep from losing your home, keep from losing your vehicle or just whatever. That it's like a life changing event. If you were to cash this out, don't just cash it out because you're switching jobs or it's really murky on how to roll it over into your new job or something. And I'm going to speak a little bit because that's what I did, and I would be so in such a better financial situation today if I had handled 401ks and rollover a little different. For one, don't be afraid to ask questions. Call somebody, if whoever your person is. If it's if I think I had one time with Co-America Bank, Co-America, I'm not sure. It's up in Detroit, and then I had one with Fidelity, and it was so difficult, or at the time it looked so difficult to roll it over into my new plan. And cashing it out was a click of a button. So I don't know if they do that on purpose or what, but I would definitely recommend for you to not do it. And here's why: you're going to pay a ton of taxes. You're going to pay a fee when you cash it out, and then you're going to pay income taxes on it at the end of the year as well. So you're going to be taxed on it twice, and it sucks. I'm just going to tell you. The first time I was in my early 20s, and I want to think mine was like $17,000 or something like that. And when I switched jobs, I had the 401k, but I didn't have anywhere to roll it to. or I didn't think I did, and it was easier for me to cash it out, and I did. I cashed it out and bought a new Harley Davidson, and I can tell you that I don't have the money, and I don't have the Harley Davidson, so it didn't work out. It didn't work out for me. Worked out short term, but then I sell the Harley Davidson, I just buy something else, and then of course that's been absorbed in some sort of debt, I'm sure, over the last 20 years. So I would definitely recommend you not to do that, okay? And not only did I do it once, I did it 3 times, okay? So that's maybe you turn your podcast off right now and you think, man, that guy's dumb. Or maybe you're like, man, I'm intrigued. This guy's really, maybe this guy has turned over a new leaf and he's smart. I would like to think that I'm smarter than I was, but I'm learning every day. And I can tell you that I learned to not do that anymore. I guess I swung twice and had 2 strikes, and then I hit a home run. And the home run was very lucky, and it was due to investing as well. But I was very lucky on the 3rd strike. But anyway, the first time, sold it, bought a motorcycle, got hit with a big penalty, and then I got hit with the income tax at the end of the year. Wasn't smart. The second time was a job I worked for a couple of years, and the 401k was it was like $7,000 or something like that. It wasn't much. Didn't make a whole lot of difference. I probably paid off some debt with it. So I mean, was it a loss? I don't know, maybe, but I would consider it. I would consider it a win. But then the latest time was it was a lot of money. It was my basically my whole career of adult big boy job, 9 years worth of 401k, and when I switched and moved to a new company, there again it was difficult to roll it over, or at least I felt like it was. Did I ask anybody? No. Did I consult with a financial advisor or with the person at my work? No. So I just made excuse, really. And I think I kept it after I left that job for a year or so. It was still making money, but it wasn't. I wasn't contributing to it anymore, so it wasn't really beneficial to me. Long story short, I sold that out and I bought stock with it, and I bought. I was in on the GameStop AMC train for a little while, so I did okay. All right, I did okay, but I was in a fear on a stock. I was involved in a stock for a period of time that shot up and did really well, and then it plummeted. And when I say plummeted, it was down to the point where I had lost all of my money except for that amount of 401k. And I told myself that I would never lose my 401k. I would never lose that money. So I lost $80,000 in a stock trade, in one single trade. And I won't discuss the ticker, what the stock was, but it was a terrible financial decision, and I lost $80,000. But if I'd kept the stock, this is where I tested my patience, and I knew that buying single stocks was not for me at this point in my life. And what I found was I did sell out. It shook me. I sold. I did not lose my initial 401k investment, which was good. However, the money that I had made on the meme stocks or whatever was basically gone. And then the stock that I sold at such a loss made a rebound in the next couple of months, and I would have been okay. But fear drove me to sell, and that's something that when you get into investing, that's something that you have to be able to control, you have to be able to handle, and it's just like gambling. The stock market is a casino. If it's not handled correctly and you don't have professionals that are dealing with your funds, there's a lot of ways to make money in the stock market and with investing. But equally, there are the same amount and probably more ways to lose. Very easy to lose money in the stock market if you're uneducated in what something's doing. Don't get on the Twitter and just read something or on some sort of feed of a certain stock, because it's like anything. You get on a certain news platform, you're going to hear good things about this, bad things about that. You go on a different platform, you're going to hear the complete opposite. So the thing with stock trading is do your own research, do your own due diligence, and make choices, and understand that the losses are real. The same as the gains are real, they can change your life. The losses are also real, and they can equally change your life. So keep that in mind. So that's really the two when we talk about investing and we talk about your retirement. You have those two options: 401k, Roth IRA. Either one are great. The longer you invest, the more you invest, the better you're going to be later on in your future when you're starting to look at retirement. Now, the majority of our listeners, from what I can see, the demographics and such, the most of our listeners are younger people, and that's really good. That's really where I wanted this to be focused on. I wanted to focus on people in their late teens, early 20s, getting a handle on life and getting a real understanding of their finances. And that's why I push for a budget. I wish that I wasn't 40 years old when I first started looking at a budget. I wish that I had more people talking about finances. I wish that there were better classes available to me in school that were just common classes that taught me just the basics, right? If I had known more about the basic type things, I think I would have made better financial decisions earlier in my life. I feel like too much emphasis is put on credit score and loans and interest rates and all this stuff, but there's not so much of saving money. Let's not worry about so much of how much we can spend, but how much can we save? That's the real thing. So anyway, that's basically the two methods of investing. And I think that I think there were like 5 or 6 emails that were all about how do I get started in investing. And your work is the easiest. I'm just going to tell you, your work, whatever your work offers, if your work offers a match, try your best to be able to be a part of that. If it's 3%, then you can look at, hey, it's only going to cost me 3, but I'm going to get 3, so I'm really investing 6. And then when you can invest 6, then 6 becomes 9, and then it just keeps growing. I think with mine, I think I'm somewhere between 20 and 25%. I think is what I'm putting in my Roth, and that's because I was so far behind. I cashed it out 3 times, so that wasn't smart. So don't be like me in that regard, but be like me today. Be conscious. Be deliberate when you are saving money. Be intentional. That's the biggest thing, and I'll say it 1,000 times over the course of the show that debt's a math problem. It's all a math problem. It's just money, and I say that very loosely. It's just money. I know it's hard to come by for a lot of us, but when we make good decisions with it, we can do more with less, and that's the purpose of this show. And that's what I want to continue to do and continue to share this knowledge with you guys. So with that, I think I'm going to hang it up. But I'm also going to bring in a challenge. This week's show is actually going to be about no spend, a no spend challenge for the month. As we head into November, there's always a bunch of no things, no shave November. There's all kinds of things that people do for a month, or try to not do for a month. And I'm going to challenge you guys for the no spend challenge. Run your own personal no spend challenge. What can you do that you're doing right now for the month of November? If we were to have 30 days of not spending money on something, what could it be? I think the first thing that comes to mind for me is coffee, and I don't know that I can do it. Another thing too, I have this little small desire in my heart that I really like Burger King, and I really like Popeyes. But I tell you what, I think here's what I'm going to do. I'm going to make a pact to you guys for the month of November, and I'm going to come back every week, and I'll give you guys an update if I caved or not. But for the month of November, my no-spend November is going to be eating out at lunch for a month at my work. So I'm not going to count the weekends if I were to go and have dinner or something on the weekend, but I'm gonna either take my lunch or I won't eat lunch. But I'm not gonna spend money. I'm not gonna spend money on lunch at work for the month. That's gonna be my no spend challenge. So I'm gonna if you guys, I want to hear what your no spend challenge is. So next week when we get another show, we'll do a money check in next week. I think that's what we're gonna do. We're gonna be hitting up episode 10. We're finishing up with a few folks with the financial coaching, and I'm curious to hear what their stories are. We finished up a couple. The first 6 weeks were up just a few weeks ago, and those guys were super excited. And I feel like we've saved some money. And if we didn't save money on the front end, we at least helped people understand where their spending was coming from. And then if they wanted to do something about it, they could do something about it. But at least we were able to identify where their spending was coming from and what their, look at their profit and loss sheet, so to speak, with their income versus their spending. So I'm looking forward to doing that with more folks. I'm curious to know what your no-spend challenge is. So reach out to us. Email's the same, shredthedebt@gmail.com. Look forward to hearing from you guys. And I hope this little piece on investing, I hope that's something. I know maybe it's been the show's been a little boring sometimes, some weeks for people that are ahead of the game of what we've been speaking on. But I hope you're still enjoying it, and the views are looking good. And like I say, I appreciate you guys. We put this show out on our YouTube channel. That's Shred the Debt. So with that, I want to thank you guys for tuning in to Shred the Debt, where financial freedom isn't a dream, it's a plan. If today's episode has helped you take one step closer to crushing your debt, don't keep it to yourself. Share it, rate it, and leave a review. If you want more tools, tips, and motivation, follow us on social media at Shred the Debt. We're on the TikTok, we're on the YouTube. I think we're even on the Instagram. But check us out, Shred the Debt. So until next time, keep pushing, keep planning, and keep shredding. You guys got this. We'll see you next week.